I apologize. I'm running a few minutes late. Get a call from the school nurse's office and God only knows what's going to happen with that. But luckily it was just about a paperwork item. So the panic has settled now. So we are going to continue plugging away with the chapter 4 lecture today. My estimation is that we will get all of the way through chapter 4 lecture today, going through practice problems related to how we account for a merchandising company when they buy their inventory items and then when they sell their inventory items. So we've already gone through the buying. We'll do a quick review of that here in a second. We'll continue with the selling, which is where we left off on Wednesday. And then we'll talk about and practice how to make an income statement for a merchandising company. Because at the beginning of the lecture, you'll remember that it's going to look a little bit different. There's that one real special expense that we have to break out on our income statement that only relates to a company that sells products, not companies that sell services. Once we are finished with the chapter 4 lecture and our practice problems, on Friday, I will have brand new practice problems for us to work on together. So that, again, we're just sort of reinforcing the accounting for a merchandising company, making sure that everybody's on the same page. On Monday, we will probably move on to at least an introduction of chapter 5, which is also about a merchandising company. Chapter 5, so in the problem that we went through on Wednesday, the very last problem that we went through was for a sale of merchandise. And we said that the sale part was the first entry because every time a company sells products to a customer, how many entries do they have to make in their accounting journal? 2. They got to make 2. One for the sale and one for the cost and inventory. Okay, so the first part of it was the sale part. This is the only entry that we made on that sale tab of our Excel spreadsheet so far. The sale part of it is just, we sold products to the customer and we charged them $1,000. Debit accounts receivable, because accounts receivable is an asset and it's increasing. That's why it's our debit. And credit sales revenue, because sales revenue is a type of revenue, which is a component of equity. It always increases equity. So that's why it's the credit in our journal. Then the cost part, right? So this is what the sort of the new part of chapter 4 introducing us in accounting for a merchandising company is that we have to debit a new expense that we were introduced to called cost of goods sold. It's the only expense that we're going to talk about in this class that doesn't have expense written right in the name. And it's a really special expense because it represents the amount, the cost of those goods that you just sold to your customer, right? How much did it cost you to get those goods? And in this problem, it was just given to us, $300. So if I charge the customer $1,000, but it actually only cost me $300 to get those goods myself, what's my profit on that transaction? $700, right? I sold it for $1,000. It only cost me $300 to actually get it in the first place. My gross profit is $700. We'll talk more about that when we look at that income statement. And then our credit is to the new asset account that we introduced here in chapter 4 called inventory. It's goods that we intend to sell to customers. So we initially buy those goods, but our intention is not to keep them for ourselves and use them. It's to sell them to customers. So because we just sold those goods to customers, our inventory goes down by $300. Okay, so what chapter 5 is going to focus on is the dollar amount in that second journal entry. That's it. That's all chapter 5 is focused on. Because in chapter 4, they make it nice and easy. And in our PowerPoint, they just told us, if I scroll down, they just told us, where is it? That the cost of those goods was $300. It was given to us in the problem. We didn't have to worry about figuring it out ourselves. In chapter 5, we're going to have to figure it out ourselves. We're going to have to use different methods that are acceptable accounting methods to figure out what is the cost of goods sold for the transaction. The amount is not going to be given to us. We're going to have to figure it out in chapter 5, and I'm going to teach you how to do that. But for now, we just want to focus on what are the appropriate entries that we have to make in our journal for a merchandising company when that merchandising company buys inventory and when that merchandising company sells inventory, okay? So a quick review of what we already did on the first tab. On the first tab, we went through a bunch of different examples of when goods were purchased by the company, right? So what we're trying to do is get a bunch of stuff on our shelves because we want to be able to sell all that stuff to some customers and earn a profit, okay? So we went through an example where we very simply purchased inventory and paid for it with cash immediately. Real nice and easy. Then we went through an instance where we purchased inventory, but we said, we'll pay you later. And in that circumstance, our supplier, whoever we're buying off of, gave us a discount. So I'm going to jump around a little bit here in our PowerPoint just to remind us. They gave us a discount. The discount is always going to be quoted like this. You're going to be given a discounted amount and a discount period. So in this example, 2% is our discount. And the discount period, how much time do we have to take advantage of that discount is 10 days, 2/10. Yes? This is all a review. The second piece of our credit terms gives us, okay, if you decide you don't want to pay early to get that discount, what is the time period that you have to pay the full amount that you owe? Net 30, in this case, 30 days, okay? And so we went through the example, and in our journal, because we paid within 10 days, that was our discount period. Because we paid within 10 days, we didn't have to give them $500 of cash. We only had to give them $490 of cash, right? They gave us a $10 discount. So because they gave us a $10 discount, our cash credit was only $490, but our accounts payable debit still needed to be $500. Because if our accounts payable debit wasn't $500, if we just said, screw it, we want to make our journal entry balance, put $490 in there, our accounting records would show that we still owe them $10. Do we owe them $10? No, we don't. So we make a debit to account payable for the full $500. We're decreasing our liability for the full $500, but then our journal entry still has to balance. So we put that $10 as a credit to inventory. Does this mean that we sent $10 worth of stuff back to that supplier, Hayden? No. So why is inventory decreasing? Yeah. Right. That cost principle that we learned about 1,000 years ago during the first week of the semester, doesn't it feel like a long time ago, right? So 1,000 years ago, in the first week of the semester, you learned that cost principle that says whatever you paid for it, that's what it's worth. So what you paid was $490. So you need to make a decrease to your inventory, but it's not a decrease in quantity. It's a decrease in value because that's how much you paid for it. Yes? Then we did a couple other of examples where, again, we had to decrease the value of our inventory. Because maybe they sent us a bunch of water bottles, right? We purchased our water bottles, but some of them were broken. So we physically actually sent those ones back. That was a decrease in quantity. Remember, Dee, we talked about the difference. There's a decrease in quantity and then there's a decrease in value. But either way, credit inventory in our accounting records, okay? So we could send some stuff back because it was broken, or we ordered purple water bottles and they sent us a bunch of blue ones. We call them up. We wanted the purple ones. How can we have the blue ones? Sorry, our mistake. We will give you an allowance that's basically just a bigger discount if you just go ahead and keep those blue ones. And we're like, sure, we could probably sell the blue ones too. No problem. Either way, we decrease inventory with that credit. Okay, so we went through a couple of examples where we did that, and then we ended our discussion with purchases with one final transaction where we bought $600 worth of inventory, but then we also had to pay for shipping. And we said, we're not going to make up a new account called shipping expense. We're not going to do that because, again, we can rely on that historical cost principle that we learned in chapter 1. And that historical cost principle said, whatever you paid for it, that's what it's worth to you. Not only did you have to pay the sticker price of $600, but you had to pay $75. If you didn't pay that $75, you would never take possession of those goods. That means that they wouldn't be worth anything to you. You have to pay the shipping, or else you're never going to get those water bottles to put on your shelves to sell to customers. Okay, so in that final transaction, our debit to inventory, this purchase of inventory, was not just the sticker price of $600, it was $675. Okay, so a quick and dirty review of what we talked about on that first tab where we were buying inventory. But then I said, okay, let's change our perspective a little bit. And let's jump down. Yeah, Tim. Yeah. Nope. I hated that too. I apologize. I should have notified you of that in Connect. So the accounting rules say that you could do either or. And I hate that because basically what a purchase discount is, it's a contra asset and it's just going against the value of inventory. Let's just decrease the value of inventory. Let's skip it. You see what I'm saying? But technically the accounting rules say you could use that purchase discount. We're not going to. So I apologize that I did not mention that about Connect. Connect will have a purchase discount account that they're expecting you to use, okay? Don't worry about that for our chapter 4 quiz or for the midterm exam. Do it like this, okay? I apologize. Thank you for bringing that up. I appreciate it. Okay, any other questions before we sort of move on to continuing the conversation? Okay, so where we left off on Wednesday was, okay, we're done buying stuff. Now we want to sell it to customers. And when we sell goods to customers, each and every time we have to make 2 entries in our journal. Because when we are a merchandising company, not only do we have to account for the sale piece of it, how much does our customer owe us, and the sale piece of it, but we also have to account for the cost of that good, the cost of that inventory that we're selling to the customer. 2 entries every single time. We began with a very simple example. The sale amount was 1,000, the cost amount was 300, and we went ahead and made our 2 journal entries in our Excel spreadsheet, right? And I already showed you those in the brief introduction that we went through. So here is our first sale transaction. 2 entries, 1 records the sale, 1 records the cost. Here's a helpful hint in terms of the practice problems that we will do, in terms of the quiz and the midterm. In the bubble of this classroom, we're always going to have a profit, okay? So in these sale transactions, you're always going to be given 2 dollar amounts. 1 represents the amount that you sold to the customer, and 1 represents the amount of the cost. Since we are always going to be profitable, the higher amount is always the revenue amount. The lower amount is always the cost amount, okay? So again, just a helpful hint to try to keep it simple as we sort of get a grip on accounting for a merchandising company. You can always assume that we're going to be profitable. So in these transactions, when you're given those 2 numbers, the higher one is always the sale amount, the lower one is always the cost amount. Does that make sense? We're always going to be profitable, okay? So let's add some layers onto our understanding of accounting for the sale of these inventory items. Remember in the purchase example, we got a discount. We didn't have to pay a little bit because we gave them our money early. We can also give our customers a discount. We can give our customers a discount on the goods that we just sold to them, okay? That same format of our credit terms, we use the same language. We use the same formatting. So either when we receive a discount because we're buying, or we give a discount because we're selling, you're going to see the credit terms quoted the same exact way, okay? So in this transaction, it's December 10th, and we decide that we want to sell goods to a customer for $1,000. That's our sale amount. The cost of those goods is $400. That's our cost amount. And we are telling those customers or that customer that this is our credit term. Somebody explain to me, raise your hand and explain to me, what credit terms are we giving to this customer? Justin. Exactly. If you pay within 10 days, you get a 2% discount, right? So 2% discount within 10 days. If you decide to forego that, you have to pay within 45 days. Okay, so those are the credit terms that we're giving to our customer. By the way, why would we do that? Why would we give our customers a discount? Does that give us any sort of advantage? It does? Manu? Absolutely. If you have that relationship with them, they're going to be repeat customers, right? That's a really good point. Why else is it an advantage for us to give a discount to a customer? Isaac? We get our cash faster. You want money in your pocket as long as possible. Okay. So let's think about this. I'm going to go off on a tangent for a second. Let's think about this on the sales side first, right? We want that money in our pocket as soon as humanly possible, because we want to be able to do stuff with that money, either invest it, buy more inventory, give our people a bonus. We want to be able to do something with that money. So we want it in our pocket as fast as we can. How do we entice the customer to give us the money early? Give them a little discount. Are you with me? Now, what about when we're on the buying side? When we're on the buying side, again, we still want to keep money in our pockets as long as possible. So we have to sort of make a decision. Is it worth it to pay off what we owe early because we're going to get that discount? Or does it make sense for us to keep that money in our pockets longer because of what we'll be able to do with it because we have it, right? You have to balance that out. So that's what the organization will do when they're trying to decide, when should we pay our bills, right? Should we pay our bills early and get this little discount? Or should we keep the money in our pocket longer and use it for something else and just pay it at the end of the term, right? 30 days, 45 days, whatever the terms are. That's a decision that we have to make as the buyer. When it comes to being the seller, right, we're putting the decision in their hands. Do they want to take advantage of the discount? We hope they do, because we want to have that cash in our hands as quickly as possible. Make sense? Okay, end of tangent. So let's just focus on December 10th. We have a sale of goods. We sell the goods for $1,000. We say, pay us later. And the cost of those goods was $400. Someone raise their hand and tell me, what is that initial entry that I'm going to make on December 10th in my journal? Kayla. Okay. And is it a debit or a credit? It is for $1,000. Then what's the other part of this first entry? Accounts receivable is our debit. That's our asset. It's increasing. Yeah, Cooper. Sales revenue. Sales revenue, right? We said instead of using consulting revenue or landscaping revenue, those other account names that we were using before in the other chapters, we just use sales revenue. It's still just a type of revenue, which means it's a component of equity. It always increases equity. That's why it's a credit in our journal. Okay. That's only one. How many entries do we have to make? Always have to make two. What's the second one? Yeah, Tyler. Yep. And I'm going to abbreviate COGS because I'm lazy because it's Friday. And inventory. Cost of goods sold is that new expense account. It's the only one that we're going to introduce that doesn't have expense actually in the name. And it represents the cost of the goods that you just sold. Accountants are not super creative when we come up with the names of these things. The cost of the good that you just sold, cost of goods sold, okay? And then our inventory asset is decreasing. Why? We don't have it anymore. We just gave it to them, right? You just gave it to your customer. So your inventory amount goes down by 400, okay? That's it. That's essentially the same entry that we made in this first. It is exactly the same entry that we made in that first example. Exactly the same, okay? So now, let's talk about this discount. And here is where it's going to get a little bit funky for you. Because in the first set of examples where we were the buyer, I said, don't make up any new account names. If you get a discount, just decrease your inventory. The end. The value of your inventory is going down. Don't make up any new account names. We're going to make up some new account names now. Okay? Because when you are on the sales side, it's a little bit different. When you're on the sales side, the accounting rules say, leave sales revenue alone. Remember in chapter 3, when we talked about depreciation of long-term assets, and I told you the accounting rules say, leave the equipment alone, leave the building alone, leave the automobiles alone, leave the computers alone. Don't touch them. Instead, use a contra asset account. Anybody remember what the name of that contra asset account was in chapter 3? Yeah. Accumulated, close. Accumulated depreciation. Use the contra asset account to show that the value of the equipment or the computers or the automobiles is going down. Same idea. In our example here, we are selling inventory, okay? And the accounting rules say, don't touch sales revenue. Leave it alone. But we have to account for the discount somehow, okay? So we're going to present a new account name in this example. But first off, we have to ask ourselves a question. I kind of gave it away, but we have to ask ourselves, are we within the discount period? If the customer pays us on December 19th, are they paying within the discount period? Yes or no? Yes, right? They're paying within 10 days. How much of a discount are we going to give them? $2. Do you apply to, not $2, 2%, I apologize, 2%. Do you apply the 2% to the $1,000 or the $400? Why, Kayla? You're right. Why? That's how much they owe you. They don't, that customer don't care about how much it costs. They just care about what's their bill. Their bill is $1,000. So if I jump over to my Excel spreadsheet over on the right-hand side, I'm going to take that $1,000. So plus 1,000 times, I use my little asterisk, 0.02. 1,000 times 2% gives me the discount that I'm giving to the customer, right? This is how much discount to customer. I'm giving them a discount of $20. Are you with me? So we apply the discount to the amount that the customer owes. They don't care about the cost. They care about what's the amount that we charge them, $1,000. Okay. So how much cash are we going to get in our pocket? Tyler, $980, right? So our cash is going to be a debit, just like any other time that a customer pays you. You debit cash, but it's not the full 1,000. It's going to be 1,000 minus the $20 discount, or $980. For a quick calculation like that, by the way, you can plug it in. I understand that you can do that in your head. Okay, $980. But every time a customer pays us, we should also show that their account receivable is going down. So our entry needs to include a credit to account receivable. How much should that credit be? Kayla? 1,000, right? If you put $980 in that credit, what your accounting records show is that that customer still owes you $20. Does that customer owe you $20? No, they do not, because you just gave them a discount. So you want the full amount of accounts receivable, $1,000, to go away. We originally said they owe us $1,000 with a debit. Now we're saying they don't owe us $1,000 with a credit. 0 should be the balance once all is said and done, right? They don't owe us any money. But I'm starting to get a little sick because my journal entry doesn't balance. I don't know what to do. What do I do? What do I need to make my journal entry balance? Where's the $20 going to go? On the debit side or the credit side? On the debit side. The new account name that we are going to introduce is going to be called sales discount. That's fine. Sales discount, Kayla. Yes. Connect. Sales discount should always be a debit, because sales discount, and you could, if we have a second after class and you want to show me and connect where it might be a screwy, we could do that. But sales discount should always be a debit, because sales discount is a contra revenue account. So we have been saying that revenues always increase equity and are always credits. Revenues always increase equity and they're always credits. So a contra revenue is just going to be the opposite of that. Contra revenue always decreases equity. So contra revenue accounts are always going to be a debit. What you are showing here is the same concept that we talked about in chapter 3 with accumulated depreciation, right? You bought a piece of equipment and the accounting rules say, put that equipment on your accounting records and then leave it alone. Don't touch it, okay? But you know that as you use that piece of equipment, the value of it goes down. So if the accounting rules say don't touch the equipment, but you still have to show that the value of it's going down, well, then we have to use a contra asset account. Same exact thing. You sold products to a customer $1,000. That's your sales revenue. The generally accepted accounting principles that we have to follow say, don't touch that. Leave that sales revenue at $1,000. But we just gave our customer a discount. So we know that our sales revenue is actually a little bit less than $1,000. We know that. But the rules say don't touch it. Don't touch it. Okay? We have to use a contra revenue account to show that our sale is actually a little bit less than $1,000. That's what the rules say we have to do. Okay? Leave the sales revenue account alone and introduce this contra revenue account called sales discount. It's decreasing the overall sale. So let's jump back to the question about gross profit. Gross profit is when we take our sale and we subtract our cost of goods sold. So when we are calculating gross profit for this transaction, what we have to take into consideration is that we did have a sale amount of $1,000, but we also had a discount of $20. This is called your net sales amount. The gross sales amount, just how much the sticker price was to the customer, is $1,000, but then you gave them a discount. So your net sale amount is actually $980. Okay. Initially, we thought we were going to have gross profit of $600 on that transaction, but then we gave them a discount. So when we take that net sale amount, I'm going to revise this, that net sale amount, we subtract our $400 cost of goods sold, $980 minus 400, our gross profit is actually only $580. It's not 600 because we gave them a discount. Okay. So purchases, we don't use any new accounts. If we get a discount from the buyer, from whoever we're buying from, we just show that as a decrease in value to inventory, the end. But when we're the seller, we're not allowed to do that. We're not allowed to just adjust the accounts that we've already been using. When we are the seller and we give a discount to a customer, we have to use this new account name called sales discount. And sales discount, because it's a contra revenue account, sales discount is going to be on our debit side. It's decreasing our overall sale amount. Okay. What do you think? We're going to need some practice on this one, right? It's a little bit funky. It's a little bit new, but that's okay. We got lots of time. Okay. We got practice problems out the wazoo that we'll work on today and on Monday. Any questions so far? Okay. So, what happens when we sell products to a customer and when they get to their place, they're broken? Right? That happened to us with our water bottles. What did we do when it happened to us? We sent it back. What do you think they're going to do? Send it back. They're going to give it back to us. Or what happens if we sell them products that they weren't actually what they asked for? What did we do? Called them up, said, hey, we didn't want blue, we wanted purple. And they said, we're so sorry. We'll give you an allowance, a deeper discount on the amount that you owe us. That's what we're going to do, right? If we sell the wrong products, they're going to call us up and we'll say, sorry about that. We'll give you a sales allowance. That means that you don't owe us that much as we originally said, okay? So let's talk through this in an example. On December 20th, we sold goods that had a value, that had a price. The sale amount is $800. The customer is going to pay us in 30 days. So there is no credit terms. There is no discount in this example. They just have to pay us back in 30 days. And the cost of those goods was $350. Okay. Every time you sell products to a customer, how many journal entries are you going to make? 2. One for the sale, one for the cost. Let's do that first. We know how to do that. So someone raise their hand and tell me on December 20th, what's one journal entry that you want to make? Yeah, Josh. Yep. And it is. What's the credit for 800 going to be? That's right. There's the sale part. Someone else raise their hand and tell me what's the second entry that I have to make in my journal. You don't count. You're not allowed to raise your hand. Tyler. Cost of goods sold. And is that my debit or my credit? And it's for how much? Was it 3?
Yeah.
350. Thank you. And then what's my credit? Inventory. We're going to get used to that quickly. You make the same entries every time. It's just when you have these discounts and these allowances and stuff that things get a little bit funky. But every time you sell products to a customer, you make these 2 entries. One to account for the sale piece and one to account for the cost and the inventory piece. Okay, everybody cool on this? On December 24th, the customer returns some of those goods that had a sale amount of 150 and a cost amount of 90. They send them back to us. Okay, let's assume in this situation that when they send them back to us, the products are fine. Maybe they just weren't what they wanted, so they sent them back. They physically returned them to us. Are you with me? We have to make an adjustment to both the sale amount and the cost amount when they send the stuff back to us. We have to make an adjustment to both on December 24th. So let's talk about first what the adjustment is going to look like on December 24th to the sale piece of it, okay? Here is the entry that we made to actually show that we sold goods to the customer. Debit accounts receivable, credit sales revenue. We now want to show that that customer doesn't owe us $150 out of that total 800. Are you with me? So the first thing that we're going to do is credit account receivable $150. What again we are showing is that we originally charged them 800, but then they sent some stuff back to us. It wasn't what they wanted. So we originally thought they were going to pay us 800, but now we're taking $150 off that bill. Are you with me? Bless you. The debit is going to be another contra revenue account. Again, the GAAP rules say generally accepted accounting principles are the rules that we have to follow. And those rules say, leave the sale amount alone. Don't touch it. $800, leave it alone. But we know we have to show that $150 of that total amount is actually not really sales revenue because they returned the stuff to us. So the new contra revenue account that we're going to use here on December 24th is sales, returns, and allowances. Sales, returns, and allowances. It is doing the exact same thing that the sales discount account did. So sales, returns, and allowances. It is a contra revenue account. It's going to be a debit because it's always going to be decreasing our revenue. So sales, returns, and allowances is our debit of $150. $150, excuse me. So we are showing here, they don't owe us $150 of that total anymore. Decrease accounts receivable, $150. And we're also showing that, yeah, the total sale amount was 800, but actually 150 of that, not really sales. They sent it back. Okay. Any questions on that? Again, this is all brand spanking new. It's going to take some time to reinforce extra practice problems to reinforce these concepts. For now, does anybody have any questions? Okay. Now, the other piece to this is that we have to reverse some of what we did on the cost side too, right? They sent those goods back to us. And if I jump back to the problem, it said that those goods cost amount was $90. We now have that inventory back in our possession, okay? So when we think about the cost piece of this adjustment, all we are going to do is reverse $90 of what we did initially. So instead of debit cost of goods sold, credit inventory, flip it. Debit inventory, credit cost of goods sold. All you're doing is essentially reversing out $90 of that entry. You're just making it like that never happened. Debit inventory, $90. Credit cost of goods sold. Let's just pretend like that never happened. Just for the $90 though, right? Not for the full $350, just for the $90. Yeah.
Your inventory is broken though. You don't really have that inventory, or you're constantly selling.
If your inventory was broken, we would, and I was going to get to that when we were completely done, but that's okay. When your inventory is broken, you don't make that entry at all. Because essentially what you're saying here is, you can't put it back into inventory and sell to somebody else. It's not an asset anymore. It's broken. And therefore, your cost just remains as it is. You're basically incurring that cost. It's like a loss, right? Because you're not going to be able to sell that to anybody. It's broken. So if the goods were returned because they were broken and you cannot sell them to another customer, this second entry would not be made. All you would have to do is make that first entry. Okay, so over on the side, I'm going to make a little note. Only made if the goods can be resold. If the goods can't be resold to anybody, they're broken, then you just don't make that part of the entry. Okay? So now, it's finally December 31st, and the customer is going to pay us what they owe us. So one thing that you have to remember is that they don't owe us $800 total, because we already said 150 of that is going to go away because they sent us the stuff back, right? So on December 31st, we have to make an entry to show how much cash are we going to get in our pocket. Don't say 800. The 800 minus 150, right? What is the net sale amount? If I take $800, that's how much my original sale amount was, and I subtract the return amount of 150, the total amount of cash that I'm actually going to get in my pocket is only $650. Only $650. Okay. What's the credit need to be? Cash in your pocket is our debit. So what's the credit going to be? Jordan. Account receivable, right? We want to show with a decrease to account receivable of 650, they don't owe us anything anymore. They're done. They returned $150 worth of stuff, and then they paid us $650. They're done. They don't owe us anything. Kayla. It wouldn't be, because if you look what we did on December 24th, right? Initially, we said, yes, they owe us 800, correct? And then on December 24th, we decreased that by 150. So because we already decreased it by 150, the amount that they still owe us is only 650. Okay. So it's important to keep track, and it's hard for me to do here in Excel, but my advice to students is to use T accounts. Remember the T accounts we learned about in chapter 2? I'm going to erase some of this stuff so I can show you what I mean. If we use a T account, you can always keep track of what the receivable amount is. If I have a T account over on the side, again, it's hard for me to do, but you could do it with your little Apple pens. If I have a T account over on the right-hand side where I'm just keeping track of my receivable, I started at 800, but then I made that credit of 150. So how much do I have left? 650. That's the amount that they're actually going to pay, right? So that's an easy way for you to just kind of keep track of what's going on when you have a bunch of different transactions going on related to that sale, right? You had a discount, you had a return, you had this, you had that. You can keep track of it in a T account, okay? Good question. One final thing on this. My net sale amount was 650. What was my total cost of goods sold for this transaction? This set of transactions, I should say. What was my total cost of goods sold? Tim, how'd you get it? It was 350, but then remember, we essentially reversed $90 of that out. We said that's not actually cost of goods sold anymore because they returned the stuff to us. So 350 was initially what we thought cost of goods sold was, but then $90 of it we just took out. We reversed that entry for $90. Okay. So the total cost of goods sold was 260. How do I calculate gross profit? Subtract them, right? I'm going to take the 650 minus the 260, and that gives me my gross profit. Okay. I'm going to ask you to do this on the chapter 4 quiz. You're going to have to make a income statement in this multi-step format, and we'll have practice problems to reiterate. But in this multi-step format, you have to do this before then you keep track of all of the other expenses, right? And again, we'll go through some examples of that later on. Okay. Yeah, Cooper. We're done because there was no discount, right? If we look back at the problem, all we said was pay within 30 days. We weren't offering them a discount. So we didn't have to worry about that for this particular problem, okay? So, does anybody have any questions before we move on to a discussion of how to prepare the income statement? Okay. Now we are going to move on to thinking about how the income statement is going to be different for your merchandising company versus what we've previously prepared already, okay? So in the income statement that we are used to seeing, all we did was create one step where we calculated revenue minus expenses, and that gave us net income. I mentioned to you that on the quizzes, when there are a few different expenses shown, you should list each one of them out individually, okay? So you should list out each individual expense. But other than that, it's just a very simple one-step calculation. Revenue minus your total expenses. That gives you your net income. Versus a merchandising company. And with a merchandising company, we have to create what's called a multi-step income statement. That's where that one really special expense that we created in chapter 4 called cost of goods sold gets broken out all by itself. The other expenses are important too. It's important to know what your salaries expense was, what depreciation expense was, what your rent expense was. That is all very important as well. But for a merchandising company, to break out cost of goods sold all by itself shows the reader of the income statement, here's how much we actually make just by selling our products, not taking into consideration any of those other operating type expenses that we have, just breaking out cost of goods sold. And that's a very important thing for merchandising companies to present, because it shows, right, how is that balance between what they sell to their customers, their sales revenue, and then the cost of the goods. You're able to see what that balance looks like on their income statement, okay? An expanded version of the income statement is shown on slide 23, okay? You can see how extensive the income statement can be for a merchandising company that has not only the sale of products, but they actually categorize their other expenses between operating expenses and administrative expenses. So this is what the income statement of a real world company could look like. I am not going to ask you to prepare an income statement that looks like this. I'll show you here in a second, and we'll go through an example of preparing one yourself. And that will be more so what I ask you to do on the quiz. But I just wanted you to see it's an extensive amount of information. Not only do they break out cost of goods sold, but they also show what the sales discount and sales return amounts were. So you're able to see, yes, what was the general gross sales that we generated for this period of time? But then also, what were any discounts that we had to subtract from that? Where were there some returns and allowances that we had to subtract from that? So not only can you see what your gross sales were, but you can see what your net sales were, okay? And then when we subtract out the cost of goods sold, we're able to calculate gross profit, representing the amount of profit, the amount of income that we earn by selling our products, not taking into consideration any other operating or administrative expenses that we have in our business, just the sale of the product by itself, okay? So again, I'm not going to ask you to make a income statement that looks like this. I'm going to ask you to make a income statement that's very simple looking like this, okay? So if you go into Moodle in chapter 4, what we have been working on where we were making our entries for purchases and sales was this chapter 4 Excel spreadsheet. Oh, I didn't open this for you. I'm sorry. Hang on a second. Hang on. There is another Excel spreadsheet where we have additional practice problems and I need to open it for you. I apologize. Okay. You should be able to see now a new spreadsheet that says Chapter 4, additional in-class problems. Okay. When you open that guy up, there's a few different tabs because on Monday, when we see each other again, we're going to go back through new examples of when we buy inventory, and we're going to go back through new examples of when we sell inventory. I have a bunch of new examples in there for you, but that's not what we're going to do right now. What we're going to do right now is on the very last tab of that spreadsheet, there is a income statement. Okay. And so this is what the quiz question is going to look like for Chapter 4. The quiz question is going to give you a series of accounts that are in completely random order and ask you, prepare a multi-step income statement. When you hear multi-step income statement, what you have to remember is, I got to take cost of goods sold out of there and show it all by itself so that I can calculate gross profit. That's your multi-step income statement, okay? So take 5 minutes and try to use those accounts to prepare an income statement, okay? After 5, if you don't get done in 5 minutes, that's okay. We'll come back together. We'll work through the solution. That'll be the final thing that we do for class today, okay? So take 5 minutes, buddy up, talk to your friends, and prepare a multi-step income statement. Use the PowerPoint example as a guide. And PS, you can do that on your quiz too, because remember, for your quizzes, you can use your notes, you can use PowerPoint, you can use Connect, you can use your class resources. What's the one thing you can't use on a quiz? Each other. Thank you. I have students in my upper level classes that still say that back to me because of how much I say it. You don't remember me saying that?
I do.
Okay. Oh, do you still say it? Ricky, I'm coming. So the way that we start any financial statement is with a heading. I was very nice and gave you one. Guess who's not going to be nice on the quiz? Me. No, I'm nice though, right? Most of the time. I'm not going to be nice on the quiz. On the quiz, it's just going to be a blank set of lines. And if you don't include a heading, I don't know what financial statement you're making, and you're going to get a point taken off. So make sure that you include a heading. And the heading should have 3 things. It should have the company's name, it should have what financial statement it is, and it should have a date of some sort or a time period that it's covering, okay? So the heading is already given to us. ABC Company income statement for the month ended February. Where do I start in my income statement? What account do we want to start with? Say it again. Sales revenue. So sales revenue given to us in this example, 86,290. I'm going to highlight sales revenue because I want to remember, hey, I used that one already. And you guys know me by now in my color coding and my keeping track of things. I used that one already. It's not going to go anywhere else. I used it. Now, what should we include in our multi-step income statement? Kayla. I'm jumping down to put cost of goods sold right here, 25,900, because there's actually something that you have to use before cost of goods sold. Jordan, sales discount. So remember when we prepared a balance sheet in chapter 3, And in that balance sheet, we were trying to figure out, well, where the heck do we put accumulated depreciation? Where does it go? We said, well, if accumulated depreciation is a contra asset, it should go right next to the asset that it belongs to, right? Same thing here. If sales discount is a contra revenue account, it needs to go right next to the thing that it's contra to. Sales revenue, okay? And it would be a negative because it's decreasing. If we give a discount to a customer, that decreases our overall sale. Just like when our assets depreciate, it decreases the value of our asset, okay? So sales discount, negative 4,100, would come before the cost of goods sold, okay? And now, I wouldn't take off points if you don't do this. But what we would normally do before cost of goods sold is have a net sales revenue amount. And that net sales revenue amount would very simply be the sales minus the discount, 82,190. If you don't have that step in your income statement, I would be okay with that, as long as you remember to put the discount right next to the sales revenue. If it's a contra account, right, the general rule of thumb, if it's a contra account, when you are trying to figure out where the heck it goes in the financial statements, you put it right next to what it is contra to, okay? So now we have cost of goods sold, but before we list any other expenses, let me highlight sales discount because we already used that. What do I have to calculate before I then show my other expenses? What do I have to calculate? Justin, gross profit. And how do I calculate gross profit? Absolutely. So I'm just going to take plus 82,190 minus 25,900. Your sale amount minus your cost of goods sold. 56,290. Now what do I need to do? List the other expenses. So salaries, rent, depreciation. And I'm just taking those amounts that are in the table and bringing them over into my income statement. Okay. I can then calculate a total expense using that little summation formula, right? I told you that's my favorite one in this class because you could tell Excel just by clicking it. And Excel says, do you want me to add this? And I say yes by hitting my return button. Total expenses, 12,580. What is the final step in my income statement? What's the final thing that needs to appear in it? Kayla, you changed your mind. I respect it. Yeah.
Your gross profit minus.
And that gives me what? Net income, right? Net income is the final thing. That's what we're trying to figure out. How much income did I generate? And the way that I do that is by taking my gross profit amount, 56,290, and subtracting minus all of those expenses. Net income, right? So whether you're talking about a service company or a merchandising company, a company who sells services or a company who sells products, the end result of the income statement needs to be net income, okay? For a merchandising company, we have to create additional steps. It's not just a one-step calculation. We have to calculate gross profit before we can then calculate net income, okay? So the chapter 4 quiz is, there's going to be a question that looks just like this. On the chapter 4 quiz, there's also going to be questions about how to make entries for purchases and sales of merchandise, right? That's what we did earlier today, and we're going to do it again with more examples on Monday, okay? So to end our class today, a few reminders. The chapter 4 homework is due on Monday. The chapter 4 quiz will be due on Wednesday. And again, I will reiterate to you in class on Monday, what questions you can expect to see on that chapter 4 quiz. I would anticipate that we will spend maybe half, a little bit more than half of class on Monday going through more practice problems for chapter 4, okay? But then the tail end of Monday, I'm going to introduce chapter 5. So that's sort of where we're going over the next few class periods. Does anybody have any questions? Okay, so one other quick thing. Excuse me. Goodness gracious.